COMEX just reported registered silver dropped below 40 million ounces. The screen says $32 per ounce, but the vault is nearly empty. This is not a market correction. This is a structural failure. The paper price mechanism is breaking in real time, and the math proves default is inevitable. I'm going to show you why industrial demand, vault mechanics, and forced delivery will trigger systemic collapse. The exchange is running out of metal, and the leverage ratio guarantees a liquidity crisis. The window to act is closing. You have to understand the difference between registered and eligible silver because this distinction is the entire crisis. COMEX holds two categories of metal. Registered silver can be delivered against futures contracts. Eligible silver cannot. It sits in the vault, but it is not available for delivery unless the owner converts it to registered status. Right now, registered silver is approximately 40 million ounces. Total open interest on COMEX represents claims on over 800 million ounces of silver. The leverage ratio is 20 to 1. Every physical ounce in the registered category backs 20 paper claims. Let me show you what happens when even 10% of contract holders demand delivery. 10% of 800 million ounces is 80 million ounces. The vault holds 40 million registered. The exchange cannot deliver. It is mathematically impossible. Now here is where most people mess up. They assume eligible silver will convert to registered and solve the problem. But eligible silver belongs to someone. Banks, dealers, large investors. They deposited metal in the COMEX vault for storage, not for sale. Converting eligible to registered means the owner agrees to sell at the contract price. Why would they sell at $32 when a delivery crisis is driving the physical premium to $40 or $50? They will not. The eligible inventory is a ghost. It will not save the exchange. This brings us to the Hunt brothers squeeze in 1980. The price of silver hit 50 per ounce because the Hunts were taking delivery and draining the vault. COMEX responded by changing the rules. They implemented position limits and margin hikes to force liquidation. The exchange survived by rigging the game. But the 1980 crisis was driven by two billionaires. The current crisis is driven by industrial demand that cannot be stopped by margin hikes or position limits. Samsung does not trade futures. Tesla does not care about COMEX rules. They need physical metal for production, and they will pay any price to get it. The exchange has a legal escape hatch called Force Majeur. This clause allows COMEX to settle contracts in cash instead of metal if delivery becomes impossible. Once the exchange declares force majeure, the entire price discovery mechanism collapses. Why? Because the futures price is supposed to reflect the cost of future delivery. If delivery is impossible, the futures price becomes meaningless. The paper price and the physical price decouple completely. The paper price might say $32. The physical premium might be $50 or $60 or $80. The screen is lying. This creates the dealer replacement problem. Let me explain. You hold a futures contract. You expect delivery. The exchange declares force majeure and settles your contract in cash at $32 per ounce. Now you need to buy physical silver in the open market to replace the metal you were supposed to receive. But there is no metal. Dealers are sold out. Premiums are 100% over spot. You pay $64 for metal, the exchange valued at $32. You just lost 50% of your capital because the paper price lied to you. Now multiply that loss across every pension fund, ETF, and bank holding paper silver. The wealth destruction is catastrophic. The system is looking for an exit hatch, but the math does not care about legal clauses or regulatory intervention. The registered inventory is dropping every month. Industrial demand is rising every quarter. The leverage ratio guarantees default. The vault math does not add up, and the exchange knows it. The question is not if COMEX defaults. The question is when. Now let's talk about who is draining the vault and why they cannot be stopped. Solar panel manufacturers alone require 150 million ounces of silver annually. Every photovoltaic cell uses silver paste for electrical conductivity. There is no substitute that matches silver's efficiency at scale. EV battery technology is adding 80 to 100 million ounces of new demand. Samsung, Tesla, and BYD are building gigafactories that require silver for battery management systems and charging infrastructure. This demand did not exist 5 years ago. It is structural, and it is permanent. The electronics sector consumes 250 million ounces as a baseline. Smartphones, 5G infrastructure, medical devices, and defense systems all depend on silver's thermal and electrical properties. This is not discretionary demand. These are supply chains that cannot function without physical metal. Total industrial demand is over 600 million ounces per year. Annual mine supply is 830 million ounces. That leaves 230 million ounces for investment demand, jewelry, and silverware. But here's the problem. Recycling only recovers 180 million ounces annually. The deficit is real, and it is growing. The math proves the market is already in deficit when you account for investment demand. Every ounce that goes into a coin, a bar, or an ETF is one less ounce available for industrial use. But the real danger is corporate shadow buying. Fortune 500 companies are securing multi-year supply contracts through OTC deals that bypass COMEX entirely. They are locking in physical delivery at fixed prices directly from refineries and miners. These deals never touch the exchange. The vault never sees this metal. The paper price never reflects this demand. Let me give you real examples. First, Solar has secured long-term silver supply agreements with multiple refineries to guarantee production capacity through 2027. Samsung has done the same for its semiconductor and display manufacturing. These are not speculative trades. These are survival contracts. Why does this create a liquidity nightmare for the exchange? Because the metal that would normally flow into COMEX vaults to support futures contracts is being diverted to corporate stockpiles before it ever reaches the market. The refinery sells directly to Samsung. The metal goes straight to South Korea. COMEX registered inventory drops another 1 million ounces. The leverage ratio tightens. The default risk increases. Now we are seeing backwardation in the silver market. Backwardation means the spot price is higher than the futures price. This is the market screaming for physical metal right now, not in 6 months. Normal commodity markets are in contango. The futures price is higher than spot because of storage costs and financing. When a market flips to backwardation, it signals a physical shortage. Buyers are willing to pay a premium for immediate delivery because they cannot wait. Silver has been in backwardation multiple times over the past 18 months. This is not normal. This is a structural supply crisis. The industrial users are draining supply, and they have no choice. They cannot shut down production lines because COMEX ran out of metal. They will pay any price to secure physical delivery. This is why the paper price is irrelevant. The screen might say $30, but First Solar is paying $35 or $38 in private contracts because they need guaranteed supply. The premium is invisible to the futures market, but it is real. The industrial demand vacuum is sucking metal out of the system faster than mines can produce it. COMEX is caught in the middle with a leverage ratio that guarantees failure. So industrial users are draining supply. But the real danger is what happens when they cannot get metal at any price. Let me walk you through exactly how this plays out. Stage 1 is registered inventory dropping below 20 million ounces. We are almost there. At the current drain rate, we hit that threshold in less than 90 days. Stage 2 is the first major industrial buyer failing to source metal and going public with the shortage. This is the catalyst. Once Samsung or First Solar announces they cannot secure silver supply, the market realizes the paper price is fiction. Stage 3 is panic delivery demands hitting COMEX. Contract holders who were rolling their positions forward suddenly demand physical settlement. The exchange cannot deliver. The margin nuke we saw in 2022 will not stop at this time because this is not speculative leverage. This is real demand for real metal. Stage 4 is the exchange declaring force majeure and settling contracts in cash. This is the moment the system breaks. Every futures contract becomes worthless as a hedge. Every ETF holding paper silver faces a redemption crisis. Investors demand physical metal. The fund cannot deliver. The premium explodes. Stage 5 is the paper price becoming completely meaningless. Physical silver trades at a 50% to 100% premium over the COMEX settlement price. Dealers are sold out. Refineries have 6-month waiting lists. The screen says $32, but you cannot buy an ounce for less than $50. Now the cascading failures start across commodity markets. Gold is next, platinum, palladium. Every exchange with a leveraged futures market faces the same question. Can you deliver the metal, or are you running a paper casino? Pension funds and ETFs holding paper silver face redemption crises. Investors want out. The fund tries to sell its futures contracts to raise cash, but who is buying a contract that might settle in worthless paper? The bid disappears. The fund is trapped. Banks with short positions face unlimited losses. They sold futures contracts expecting to buy back cheaper later. But there is no physical metal to cover their shorts. They are forced to settle at any price. The losses are catastrophic. Credit default swaps trigger across the precious metals sector. Banks that wrote insurance on COMEX delivery default. The counterparty risk spreads through the financial system like 2008. This is the 2008 parallel. When paper derivatives lost connection to underlying assets, the entire credit system froze. Lehman Brothers collapsed because nobody knew who was holding the toxic paper. But this is worse. You cannot print physical silver like you can print dollars. The Federal Reserve can inject liquidity into a banking crisis. They cannot inject silver into a supply deficit. The mathematical certainty is this. 800 million ounces of paper claims against 40 million ounces of registered metal equals default. There is no regulatory fix. There is no bailout. There is only the physics of scarcity. The system is looking for an exit hatch, but the vault is empty and the leverage ratio is tightening every month. The The COMEX default is not a prediction. It is arithmetic. The COMEX default is not an if. It is a when. The paper price will lie to you until the day the vault is empty. Physical ownership is the only protection against settlement in worthless paper. Do not wait for the exchange to announce the crisis. By then, premiums will be triple spot and dealers will be sold out. Subscribe for the vault updates and delivery data no one else is tracking. The window to act is now, not next month.